mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome back, everyone. Welcome to the Poole Locke YouTube channel. I am James Locke. Today we are going to answer some of the Ask James questions of the day. Our first question today comes from Cameron. He says, I've heard you mention predictable and repeatable cycles before. So wouldn't that make growth investing easier over time? All right, Cameron. Hey, first off, thanks for being a consistent viewer. I have talked about the secular market cycles. And Cameron, you're right. Historically, things were very predictable and repeatable. So it seemed, over the long run in history, we've had, say, going back to the 1800s, we've had 15 to 20 year bear market cycles where the market was underwater for 15, 20 years, just like it was underwater from 2000 to 2013. That was only a 13-year period, right? And then the markets did really well for maybe 10, 12, maybe even 15 years, and that these alternated in what historically seemed to be a predictable, repeatable fashion. But Cameron, that has changed. It's changed a lot, and it's changed for several reasons. Number one, the record amount of things that essentially manipulate the markets. So, what are some of these things? Well, first of all, there's corporate buybacks. Companies are using a lot of money now to buy back shares, whether it's profits or whether it's issuing bonds and borrowing money to buy back stocks, because in doing so, they create an artificial demand for their stock. They drive up the price. But corporate buybacks aren't the biggest. Perhaps the biggest thing is the Federal Reserve's unprecedented involvement in the markets by driving down interest rates. In fact, that's why I think the 2000 to 2013 period where the market was underwater was, a lot shorter. It was a shorter period of time than on record before, for a secular bear market. Because the Fed started they lowered interest rates to zero for the first time ever in 2008 in response to the financial crisis. And then they injected financial steroids, if you will, into the market. And by doing so, they caused the bear market to recover more quickly. And then they actually caused the bull market kind of in the teens, the 20 teens, right? And again, the Fed did it again when the pandemic hit by jamming interest rates back down to record lows, and again, continuing to control the markets. So you can argue, even now, they've kind of controlled inflation, not completely, but they're lowering interest rates again. So with the unprecedented manipulation, I would give less credit than I have in the past to the predictability and repeatability of these particular stock market cycles. Now, this is particularly relevant for retirement investors today, right? What this means for those planning their retirement income strategy is that we need to be more flexible and dynamic in our approach. The old rules of thumb, right? This traditional 60-40 stock bond split, it may need to be reconsidered. I recommend what I call, responsive allocation strategy, where you maintain core positions, but also keep some basic tactical flexibility to adjust to these new market dynamics. This might mean having a portion of your portfolio that can be shifted between different asset classes as conditions change, while still maintaining a strong foundation of income-producing investments. Remember, in retirement, consistency of income is often more important than maximizing growth potential. Thanks for the awesome question. If you would like to send in your question, you can do so by emailing it to us at poolelock@poolelocke.com. Moving on to our second question. This email is from Paul. He asks, as a financial advisor, so another advisor watching us, great. I was with a big firm, but I realized there were a lot of conflicts of interest, so I joined a smaller firm, but there's still conflicts of interest there. So really, what can I do? Okay, well, first of all, Paul, good for you for making the jump to an independent. The big firms, they do have some benefits. They have deeper research. It's not all bad, right? But you're right. if it's a big firm that's publicly traded, then Paul, you're smart enough to know that their fiduciary responsibility isn't to their clients, it's to their shareholders, which means that if they have two choices to make, right, number one is something really good for the clients and only okay for the firm, versus another one that's really good for the firm and okay for their clients, they need to pick the latter. They need to pick the one that's really good for the firm, even if it's just okay for the clients, because their fiduciary responsibility is first and foremost to the firm. So, you left and you became independent. Good for you. But you might be thinking, okay, I'm with an independent firm now. Why do I still feel there's a little bias here? Well, sometimes it's not just so much what you're talking about, but for example, where did the founder of your firm start? If it's, from an independent firm now, did they start with one of those big firms like you did? And if so, maybe some of those biases kind of continued to them in this independent world and affects how they control their firm. Now, in my case, I can say it doesn't affect how I control my firm. I became independent and started my own firm, because I didn't like what was being taught in those bigger kind of brokerage houses. So, maybe that's part of it. The other part of it could be because, maybe they're not publicly traded. Maybe, it's independent, but they're more worried about making money. So they want to get you in things that are more profitable for the firm. And we all know, Paul, that over the long run, the stock market outperforms other things, right? So if they put you in all growth-oriented stuff and not just dividend stocks, but high growth stocks, over the long run, your assets under management are going to grow and the firm's going to be able to charge a higher fee. So that could be something that's going into the mindset of the firm. I don't know. I can't answer for your firm. I don't know the owners of your firm. Maybe it's just, hey, maybe they purely believe in this, right? Maybe a lot of their clients are younger and that strategy makes sense. And maybe your clients are maybe atypical clients, right? I don't really know. But all I can encourage you to do, Paul, is to figure out, based on your clientele, what's right for them. And make sure you're aligned with a firm that can provide what you need to do in your heart, in your conscience for your clients. This is especially crucial when it comes to retirement income planning. One thing I've noticed in my years of practice is that many firms, both large and independent, tend to push what I call the one-size-fits-all approach to retirement income. Now, they might have a standard portfolio model that they apply to everyone regardless of individual needs. But retirement income planning requires a more nuanced approach. Each retiree has different income needs, risk tolerances, and time horizons. Some might need higher current income, while others might need portfolios to grow to offset inflation over a longer retirement period. So this is why it's so important to find a firm that allows you to truly customize your approach for each client's specific situation. The key is to have the flexibility to use different income generating strategies, whether that's dividend stocks, bonds, annuities, or other vehicles, based on what's truly best for each individual client, not what's most profitable for the firm. Paul, thanks for that awesome question. As always, if you would like to send in your question like Paul did, you can do so by emailing to Locke@poolelocke.com. And if you like what you heard today, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source. See everyone soon.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank.